I'm Andrew Latham, Vice President of Exploration Research at Wood Mackenzie, and this presentation looks at recent exploration discoveries and future trends in the oil and gas exploration sector. I'm going to begin with a look at the decade running up to 2016. It's basically a decade when oil and gas exploration was in real trouble. These 6 charts show exactly what I mean by that. So top left, you can see that exploration spend began to decline rapidly from 2014, which maps to when the oil prices fell in that year. The next chart shows that the number of exploration wells was also sharply down from 2014, and to the right of that you can see that success rates for those wells also started going down from that year. So it's no surprise when we look bottom left at the volumes discovered that we see much smaller volumes being found by exploration, and that there are rather fewer large and giant discoveries in this period as well. But perhaps the most important chart on this slide is bottom right. This shows the decline in full cycle exploration returns that the industry was achieving. Throughout this decade, those returns were never good, but they fall to very low levels in low single-digit percents at the end of this period in 2016. That's basically an industry that was losing money in large scale. If we jump forward now to a more recent look at the sector, we can see that in 2017 and 2018, exploration industry returns have recovered sharply. We're well into double digits for those years, which is shown on the right-hand chart for returns, or on the left-hand side in value creation terms. What's happened here is that the industry has been able to reduce its costs substantially. It's focused on less complicated opportunities where there's a reasonable chance of early commercialization in the event of any success. There's also a fiscal element to this as well. So companies are shying away from places where the fiscal terms are not helpful to good exploration economics. So we're now back in the black. The exploration sector is making money. This map just shows some of the larger discoveries that were made during this 2-year period of return to profitability. In green are the oil discoveries, and in red are the gas discoveries. And you can see there are lots of these different finds around the world. Now, not all of these will prove to be commercial, but it's already clear that most of them are. A lot of the oil discoveries are around the Atlantic margin, or more generally in North and South America. And a lot of the bigger gas finds are in Africa, in Europe, and in Asia, although there are also some decent oil discoveries in these continents as well. This chart just shows the distribution of conventional oil and gas finds for the 4 years since we saw the oil price fall, so 2015 to date. Green again is oil and red is gas. And what we've done is pick out with these blue stars those countries where the majority of these finds are coming from new plays or even from new basins. And it's very clear that that's true for the majority of the countries that have added the biggest volumes in this period. So the oil and gas sector has suffered steep declines in prices. It was struggling with getting its economics back in the black, but it was not shying away from innovation and opening up new plays and new basins, as is very clear from this chart. And I'll come back to that point later on. However, if we take a longer term perspective on these volumes, what we see is that the recent years' conventional exploration industry has been very small by comparison with previous decades. So the last few years we've been adding 15, perhaps 20 billion barrels of oil equivalent in new fields at best. And those are the lowest annual volumes that this industry has achieved for more than 70 years. Why is that? Well, one way to understand the root cause of this is to look at this data on a creaming curve basis. So the little inset chart there shows the full history of our industry, 100,000 exploration wells over more than 100 years. And you can see that I've picked out in red the gradient of that creaming curve for the last 50,000 or so wells, which actually corresponds to the period since about 1980. And you can see it's very much a straight line. So that means that the discovery rate through this period happens to be around 25 million barrels of oil equivalent discovered per well. And in fact, that rate of discovery has not changed even in those recent years. So from that we can infer that the real cause of small volumes in recent years is nothing more than we've had fewer wells completed. We're still getting that 25 million barrels discovered per well, we're just having fewer wells drilled. The other thing to say is this is all conventional exploration volumes, but I can bring on here in green the contribution that has come from the tight plays, the unconventional plays, and that has been at a scale in recent years that has been larger than conventional exploration. So put the two together and you can see that we're actually in a period of relative abundance in terms of new resources being added by the industry. So this chart shows the distribution of discoveries, conventional and unconventional, over that long century period through the full history of our industry. And the real point of the chart is to look to the right-hand side at the most recent decade, where we see that the overwhelming majority of new volumes are coming either from unconventional plays, which is shown in green, or from the grey conventional deep water discoveries. So the industry has very quickly moved to one that is overwhelmingly focused on these two technology frontiers, the tight plays onshore and the deep water plays offshore. But if you look to the pie chart on the right, you can see that the sum total of volumes ever found from deep water exploration or in all of those unconventional plays is only about 10% of all of the oil and gas that the industry has added. Now, one thing that tends to happen when we look at these long-term exploration discovery charts is to compare that to global oil demand. So this chart is just the oil coming from conventional exploration, new discoveries, and unconventional tight oil plays in the dark blue. Let's compare with that line, which is global oil demand, currently running at about 30 billion barrels per year. You can see that for most of the last 30 or 40 years, these new sources of supply have struggled to match global consumption. And of course, for a long time, that triggered considerable debate around the concept of peak oil. We were apparently using more than we were adding through new exploration. And maybe that's a concept that we will come back to in future and we'll hear more of. However, the real story is never quite so simple. And here what I'm doing is saying, well, exploration is only part of the oil supply story. Look at the left-hand chart there. That's data on global oil reserves, initially on the left-hand side, as we understood them to be in 1980. And in that year, we thought we had about 700 billion barrels of remaining oil reserves. Since 1980, in the dark blue, you can see roughly equivalent volumes again coming from new conventional discoveries, and in the grey, a smaller contribution from the unconventional plays. But of course, since 1980, we've also had nearly 4 decades of oil consumption, and that's the production shown here in green. Now, if that was all you knew, we started with 700, we've added 700, but we've produced 900, you would be expecting that we would have less than 700 here in 2018. But in fact, when we look to the 2018 data on the right-hand side of the chart, you can see that the current estimate is around 1.7 trillion barrels. And the only way that we can square this circle is to recognize that there have also been some revisions to those earlier numbers for the legacy assets. And in fact, those revisions have been larger than the contribution from exploration through this period. The right-hand chart shows the same data on an individual annual basis through these 4 decades. And so what you see is in most years, there is in green, consumption of initially 25 growing to about 30 billion barrels of oil per year. And in most of those years, the new discoveries in blue or the unconventional plays in grey fail to meet that 30 billion barrels of consumption. And it's only when we add in these revisions that we see that actually we are revising upwards by more than we are consuming. That's to say, at the end of each year, despite the fact that we've had all that production, we're exiting the year with more reserves than we started the year. So we see 2 really key strategic themes in exploration. The first of those is this focus on deep water sweet spots. And by deep water sweet spots, I mean a focus on highly productive reservoirs. The chart shows recently sanctioned, commercialized oil discoveries in deep water according to the depth of their reservoir and also the productivity of their reservoir. And here we're measuring that productivity by the average millions of barrels recovered per development well. And you can see that for the best of these fields, very often in Latin America, in Guyana and in Brazil, we're getting 30, 40 or even more million barrels of oil produced per development well. So even if these deep water wells have high individual costs, because they recover so much, because their productivity is so good, the economics is often very exceptional. So the second strategic theme is one of new frontiers. And here we're looking at all of the conventional discoveries completed over the last 12 years or so, according to the maturity of the play in which the discovery was made. So beginning in light blue with unproven frontiers. So these are frontier plays where there has yet to be any discoveries at all. Then in the darker blue, the proven frontiers. These are plays where there have been discoveries, but there is not yet any production. And then we step through emerging into the various different categories of maturity, all the way up to late mature. But the key takeaway from this slide is that the two blue categories, the two frontier categories at the bottom, typically account for around half of all of the volumes discovered in any one year. That's to say that most exploration, or roughly half of the volumes added by exploration, are coming from plays that have yet to produce a single barrel of oil or of gas. That correlates to better exploration economics very often. So here we're looking at our economic data for plays by maturity. Left-hand side, no surprises, you can see that discovery sizes are very often much larger in the unproven frontiers and in the proven frontiers, and it sort of steps downwards as plays mature, so that the smallest discoveries tend to occur at the late maturity stage. In the middle, you can see how costs vary by play maturity, and because of those economies of scale, costs tend to be lower in the frontier stages of play exploration. And that correlates on the right-hand side to higher economic returns. So lower costs, and actually there tend to be lower taxes because there are a lot more fiscal incentives for exploration of new frontiers than there are for exploitation of late mature plays. So overall, we're seeing here that although there's more risk in frontier exploration, the returns for explorers that choose to invest there are usually higher. Now, overall, we don't see a rebound in the level of exploration spending, and one of the reasons for that is because a lot of the sector is wondering what will happen as we go further into the overall energy transition. Our base case view is that demand for oil will continue to grow, but at a slower rate, until somewhere in the mid-2030s. But there are lower carbon scenarios out there that imply rather lower demand for oil, and the possibility that we don't really need very much more exploration in the decades ahead. That's an uncertainty that is compounded by the possibility that the tight oil plays will continue to produce much more strongly than perhaps is the base case view of those as well. So will the end of oil demand growth spell the end of oil exploration is a very valid question right now, and that's holding back investment in the sector. So to summarize, these are the key exploration themes that we see. Firstly, it's clear that the industry is much smaller than it used to be. It's about half the scale that it was as recently as 2015, but it's also much more profitable. That smaller scale means that there's less room for the corporate diversity that we used to see, but it's clear that the majors are very much sticking with oil and gas exploration as they look to grow beyond 2025. The overall industry spend in exploration is not going to bounce back. It will stay cautious. And that means that there's little sign of inflation coming back into the space anytime soon because there's no bottlenecks in the supply chain. The two key strategic themes of deepwater sweet spots and high impact new plays and new frontiers look set to stay. And overall, we see those supporting an industry staying with high full cycle returns well into double digits, an industry that is clearly very profitable. Thank you very much for listening, and if you liked this lecture, please go on to the EAGE YouTube channel where you'll find plenty more just like this.